Let me give you a little economic perspective over here. If you currently have $2 million, in 40 years, if we adjust this amount with inflation, your $2 million will have a buying power of only $758,000. The other day, I had a friend who is trying to acquire two different summer and winter resorts, right, outside of the US. And he was trying to identify, is this a good deal? Is he overpaying? What is the biggest risks associated with it? We sat down, right? We run the numbers. We look at one of the companies, it's a public company, the other company is private. We run the numbers on the public company. What you really want to focus and what you really want to understand, right? You have to have an idea. What are the assets of the company, right? Could be hotels, could be commercial infrastructure, which could be areas where people have stores, people have food courts, right? You rent out all these locations in the resort, and this is all come down as part of your commercial space for rent. This is a revenue source of your resort, right? On the flip side, you also have a chain of hotels which are inside the resort. As a matter of fact, majority of the liabilities of this resort are actually coming from hiring, employment benefits, maintenance of the buildings, because as you know, if you run hotels, all of these hotels, they should have, year-round water and electricity. You may not need to hire a full staff, but you still have to maintain the building, right? And also, we remember very well what happened with the building, with the condominium building in Miami, which essentially went to the ground, right? There was a structural issue whatsoever. So you understand that the book value of the public company, understanding the book value versus the value of just going on the open market, purchasing all the shares or making tender offer to acquire all the shares, is your main comparison, right? Starting point to value the deal. Meaning, let's say a company, in this particular example, this resort has 1 million shares in circulation that could be bought or traded on the open market. Let's say this company has $20 a share at this very moment, market price. Let's say you want to acquire the controlling package, which will be over 50%, right? You want to acquire 51%, you want to buy this amount of shares on the open market times $20 at the current prices, right? So you get the number, and then the corporate law will allow you to make a tender offer for the remaining 49%. You combine both numbers, how much out of pocket will cost you to acquire 90 to 95% or 100% of the company versus how much is the company actually worth on the side, assets minus liabilities, which will give you the book value. So if it costs you to buy all the shares on open market, let's say 20, 30, 40 million dollars, but the assets minus liability is giving you $100 million, well, you're buying a very, very good deal, simply because if you close on the open market tender offer plus buying up the remaining shares and acquiring to the public offering, you essentially ending up with $40 million upside, which is not yet profit, because we all know there is a cost associated with the actual transactions. You most likely will need an investment bank to help you to essentially carry the deal, to broker the deal for you. You want to make sure that you have their own due diligence, because sometimes, somebody else has to look at the books. The books sometimes might be cooked. They might be different two ways of accounting, especially when we're talking about a company that is outside the US. So very important. This is your starting point. You don't have to be an expert, but you need to have your own idea and estimates of every single deal, where it makes sense, ballpark, and where it doesn't. Obviously, one of the biggest schemes that no one actually talks about when you start counting your money, when you start trying to compute all the assets that you have minus liabilities at this very moment, trying to identify what is your actual net worth, is the problem of inflation. And inflation is your biggest enemy. It's not the prices going higher, it's not the taxes, it's not that some of your investments might not perform as you expect, might actually underperform the market, might underperform the treasuries, might underperform the passive investments, which could be in government paper or whatsoever. The biggest enemy remains inflation, because you're not really fighting inflation. The only way to fight inflation is to stay out of cash and your cash sitting in assets which prices are going in the same direction with inflation. For example, if you have a portfolio of 10 cars, which are sports cars, which are, let's say, limited edition cars, one of 100, one of 300, etc., right? If these cars had MSRP of $150,000 and you purchase one car and you purchase 10 more cars, you create a portfolio. Let's say you spend $15 million, right? Because inflation goes up 8-10%, you no longer have $15 million portfolio of cars. Your portfolio now worth maybe $20, $25, $30 million. This is why inflation actually works in favor of the rich people who own assets. Rich people who simply sit in cash, they don't really benefit. They in fact struggle as the poor people because the asset appreciation is not there. In the beginning, AI was not even a thing, and in the end of this year, everything is AI. People no longer, even speak about crypto. If you look at all the positions that I have here, even on the Forex markets, everything is closed. I have closed almost. I think I have only one open position on the stock market. I have 4 open on the crypto. The crazy part is that people usually overestimate the failure and underestimate the opportunities. Like they overestimate all the potential risks, everything that could go wrong if you really think about it. You try to start a business, the first thought you had is all the things that will not work, that you can't do, that you saw somebody else fail to do so, right? People are not looking into, okay, you know what? I actually have some experience in this. I actually might have been positioned in the best way to succeed in this because I know this, I've done this, or I work alongside people who have done this. Like I said, people are sabotaging themselves all the time. I've seen people working the same job for like 3, 4, 5 years. They kind of like the job, but they don't see that the opportunity you can make more money, and they simply quit and shift to something else. And maybe 1.5, 2 years later, they see somebody on Forbes. He created a business out of this, and they kind of wonder, how is that even possible? Because they know they have experience, they know the industry, they know the business, but they simply didn't see the opportunity. Something that I just mentioned. Like I said, people usually overestimate all the risks. If you're going to pine for gold, you don't really think, oh, I'm not going to find gold. You don't try to demotivate yourself. Why would you do that? If you really want to find gold, you're going to be optimistic. You're going to make sure that you give yourself the highest possibility chances. You're going to print all the maps, all the areas, all the research that has gathered together with the highest possibility of gold concentration in this particular area. And you're going to find all the tools that will give you the best chance to find gold. You're not going to go and, bring the least important tools or the least capable tools to help you find for gold, or you're not going to go in the middle of nowhere where there is no single study or research that has potential to has gold. People are usually sabotage themselves. It's like you're going to have an MMA fight, right? You don't think, I'm going to lose. Not quite. You just prepare yourself and you give 100%. That doesn't mean you're going to win. 100% is not guaranteed win, but it just gives you the highest possibility to actually achieve the success. Think about it. What could go wrong if you give 100%? That's an honest question. Think about it. A lot of people don't quite make it for 2 main reasons. They're either lazy to give the 100%, or they don't believe enough to give the 100%. Because if you're lazy, you're not going to give 100%. And if you don't really believe that something could happen or will happen, you're still not going to give the 100%. People usually give the 100% only when they're completely sure that something is very certain. It is going to happen, right? It's like you're trying to approach a glass of water. You're very certain you're going to get the glass of water because it's very obvious. They have a full concentration. They're approaching the glass. They grab the glass, they pull back. But this is a very simple example. People are not that certain in important things in life, which is kind of weird. Because, planning and execution combined with giving the 100%, I don't really think that things could go wrong. Just think about it. If you really give yourself the 100%, and if you really focus on the opportunities, you may actually overstate the opportunities and understate the risks. Because what is risks, right? Majority of the risks are associated with luck. If you want or don't want to admit it, if you think deeply, there's a lot of luck involved in absolutely everything. This is just a simple illustration if you get an average cycle of the inflation every single year. But we all know this is not the actual number. The actual number might actually be higher. Why? Because the Federal Reserve is printing more and more and more money. Don't buy real estate in big cities. I've said this probably 6-7 years ago. And yesterday I came across a very interesting study showing that anyone who purchased real estate in New York City after 2009 is currently underwater. That's not a surprise. We all know everything is extremely overpriced, and the maintenance of these buildings is extremely expensive. It's not just to buy the building. I ran a very interesting case study last year. We made a comparison with renting the exact same unit in Hudson Yards for $5,000 a month, 1-bedroom apartment, everything included, versus owning the exact same apartment outright for about $3.5 to $4 million. And owning it came up with much greater price tag. You have HOA, you have maintenance, you have tips here and there, you have to furnishing, you have property taxes, you have closing costs. Then at some point, if you decide to sell it, you still have to pay taxes on this. So it's much more complicated than you can think of. Also, if you just have a span of 10 years, let's say you come here to the city, let's say you're planning to live here for 10 years, business, work, startup, whatsoever. Let's say you pay $5,000 a month, right? You live there every single year, will cost you just for rent $60,000, and that's it. You don't pay HOA, could be another $1,000, $1,500, $2,000. There are crazy buildings in the city, especially in southern place. You will see crazy listings. You will see penthouses that have $9,000 HOA fee every single month, which is mind-blowing. So like I said, you spend 10 years in the city, you pay $60,000 per year, that's $600K. That's it, that's all you have to spend. A lot of people will say, but gee, that's $600K, I could have paid this towards my mortgage, towards my equity, I could have buy. No, you cannot buy the apartment. Like I said, the same exact apartment runs for $3.4 to $4 million back then. Now, with this crazy development around Hudson Yards, might be even upwards of $5 million. And just buying it, not all of these new developments will essentially allow you to mortgage it. A lot of them, especially when we talk about co-ops, will not let you to mortgage. You have to have the money cash to be accepted. Don't get me even started with the co-ops. But let's go back to this example. So the idea here is that if you decide to buy the exact same property, right, you not only have to deal with the crazy price tag, you have to deal with the interest, which is variable, which we all know currently is stuck 6.5%. You have to deal with furnishing, you have to deal with property taxes, with closing costs, you have to deal with broker fees, you have to deal with keep up and maintenance of the building, you have to deal with the HOA fee. Also, don't forget that New York has additional taxes on properties that are above certain price tag, right? There's something very similar that was implemented 2 years ago in LA. So remember this very well. The cost that you will have and you will accumulate in the beginning of your purchasing throughout this 10-year period will surpass $600K many times over. And you can play around, you can say, you can just invest the difference. Where is $600,000 versus, let's say, $2.5 million, depending how much you're paying on monthly pay, it's how much your equity will actually gain towards this period. But remember, every 10 years in New York City, there's a major reset in prices. A big tycoons, people who own a very amazing real estate, properties in the city lost tons of money. You saw Rupert Murdoch, he lost, I don't know, upwards of $10 million. Yesterday I watched a report of Tommy Hilfiger, the location in Plaza Hotel, the absolute corner of the world. You have the penthouse in the corner, and the original price that was listed for many years that no one actually paid for. Eventually he sold this penthouse on steep discount. Not sure, $20-30 million under the asking price. So this is why it's a complete waste to try to purchase real estate in big cities. I'm not sure how profitable or successful could be if you just buy a home in terms of probably a house in the city, like a city house. But again, taxes, property taxes are completely destroying the value and the appreciation that you expect to get. Because a lot of these people who are spending $20-30-40 million, they don't really look for potential flip. They just probably try to either park some cash, which, like I said, it's not really good, because the maintenance, the keep up, you have a holding cost that is very high when you essentially decide to jump into one of these crazy rallies, right? Then you have to deal with a lot of issues, right? Remember, there's the limitations. Certain buildings are changing the rules. Also, you know, the keep of the building, maintenance, the HOAs, they're going higher. They're not going lower. Also, the property taxes will essentially keep going higher and higher. They will not go lower. So there is this constant battle of you know, trying to find a reason. Why did you actually decide to buy and to spend $3-4 million upfront if you just buy cash, right? Which is obviously probably one of the best decisions if you really want to get into, instead of paying the interest, which spread out through the variable periods. You can take average of probably around, I don't know, you might go up to 30-40% of the actual purchase price could go above just from interest alone. So again, I don't really see the point. There's no actual point to own in the big cities. I think in the small cities, yeah, sure, definitely. There are deals. I know. I have friends who purchased in Pennsylvania, right? Houses a couple of years ago for like $60,000-70,000, and they flipped them for $90,000 maybe. They have a holding cost, very minimal. The other day I was looking very beautiful houses across the city in New Jersey that are facing the city. They have a beautiful skyline, and then I dig deeper and I found out New Jersey has one of the highest property taxes. This is one who wants to buy these mansions. They're perfectly located. They're spaced out. They're not close to each other. Beautiful views, unobstructed. You never have obstruction of these views simply because of the river. But when you go and look at the register, and when you look at how high are the property taxes in New Jersey, you kind of wonder, okay, what's the point at the end of the day, right? We try to make money first very hard, and then we try to preserve the capital. And you know, at some point, some people might just decide to be smart with the money, because it's very easy to lose not only money but value in the money. And if you look at the cycles, when the Federal Reserve turns on the money printer, every cycle that follows actually has higher amount of money printed. And this cycle started on December 11th, and they started with $40 billion, which is unheard of. They don't call it money printing. They have a special term that doesn't really sound that bad, but you really want to pay very close attention to the inflation. And when I say inflation, I'm talking about the actual real inflation rate, not the one that is reported. Recently, I heard plenty of people are speculating that the current real inflation is around 8 to 9%. If you look at the prices, a lot of people wonder, but when inflation was lower, the prices were lower. Now the inflation that is reported has come down. Why the prices didn't go down as well, right? Considering same thing happens with the gas, because if you look at the prices per barrel, the prices in Europe are not going down. I have plenty of friends. We usually have a at least one meeting a week and asked him what's going on, what are the prices of gas, right, of petrol. And said, no, the prices are almost the same. The price is not going lower. And this is not because the stations, reloaded on the old prices where it was expensive and they have to sell on these prices. They already get the new fuel recharge, which was on the lower price. So again, it is very easy for companies to remain selling on the higher prices, even if the economic indicators might, at least on paper, show that the prices should be lower and at least everything goes back to normal, right? But again, $2 million today, if you do nothing with this money, put them in the bank, taking an average, I would say, pretty understated expectation of 2.5% annual inflation, which in my opinion is mind-boggling, very, very low, unrealistic. It will only have a buying power of $758,000. This is a big shock for a lot of people out there, because imagine you have, $2 million today in your retirement account. Sure, no one said you're gonna live 40 more years, right? But let's add on the numbers. You're definitely gonna be shocked if this $2 million can only buy you $758,000 worth of goods in this economy in 40 years. Think about how much the prices of the average home will be. Right? Think about how much the prices of whatever usual grocery bill will look like. Right? This is why I made a video yesterday explaining why the inflation is your biggest enemy. It's not about taxes going up or down. It's not about having, let's say, bad investments. It's not about having, standard of living going higher due to the whatever migration or concentration of wealth. It's about being able to come up with your own plan, with your own finances and asset allocation plus protection to fight the inflation. Right? This is the main goal here. This is why a lot of people got rinsed yesterday on Palladium. A lot of people got rinsed on silver, and even more people gonna get rinsed on gold, but don't tell anyone. Why? Because, guys, all these precious metals didn't go up in price because they became more valuable. No, they became pricier because the value of the dollar went down. So what this means, when the value of the dollar goes back up again, the value of these precious metals, or the price of these precious metals, will go lower. And it's not only this. We're currently having perpetual futures on the crypto market. And the volumes in these futures, which the retail crowd loves so far, indicates that a lot of this trading volume will be moved away from this current hype speculative trending assets. And this is very interesting because I look at a chart of last 45 years of Palladium, and the losses that happened yesterday, this gigantic red candle, were uncomfortable, right? The people who bought at the top, some people I read in reports that they don't see them breaking even maybe the next year and a half. And this is also a very similar story with the people who bought silver 10-15 years ago. So just last couple of weeks they were able to break even. People who bought the previous top in silver 10 years ago. Imagine you buy silver at the previous hype and then you wait 10 years more or less just to break even. I was also looking very similar related to this story about people, example, if they purchased $10,000 worth of Nike stock in 2008 or 9, and they said today your investment will be worth $9,400. Imagine you locked $10,000, you wait 10 years, and you're still down $500-600 on your investment. And Nike is a great company, right? It's not some unknown company with unknown products. This is where the fundamental analysis comes into play. It's not only technical. This is where you really understand what is the life cycle of the company, in what part of the cycle the company is. You really have cost-benefit analysis, and you should really get the discount cash flow analysis and the future value of the company, depending on the also current competitors. Where is Adidas? Right? Where is Jordan? Look at all the companies that more or less move together in the same niche. The demand is still there. People still buy shoes. Even the secondary market, people who are flipping shoes, I've seen plenty of those online crying over they cannot sell the shoes they have in stock. And I've seen them at least stating they have a limited edition $300 pair of shoes that they're willing to sell right now for $150, and there's no one out there. There's no one even looking or asking questions, which again puts the market valuation for Nike in particular in completely different stage. This is why Tim Cook from Apple reasonably understand that, and he purchased some shares.